Hey, good afternoon, everybody. I want to take this opportunity to welcome everybody to today's event. It's our top 10 stock picks preview. Today is Wednesday, February 16th. You got John Hopkins, Tom Bowley going to jump in just 1 minute. If you're new to earnings beats, really appreciate you taking the time to give us a try. Thank you, our seasoned veterans. As you know, we wouldn't be here without you. This event will be recorded tonight. For some reason, you're unable to stick around, no worries at all. Also want to mention part 3 of our February webinar series coming up on Saturday. If you get a chance, you really want to try and get in on this particular event talking about growth stocks or maybe overlooked. Good timing. Tom, I know there's a lot to cover here, so I wanted to be really brief. The wacko market continues.
Yeah, honestly, I don't know what to expect from day to day, hour to hour, morning to afternoon, and so forth. Volatility's high, a lot of news, a lot of headline news, a lot of not so great news. Technically, we've got a lot of issues with some key areas that were leading the market for a long time. So I think we just got to, and sentiment needs to be reset in terms of the equity only put call ratio. So we just got a lot of things going on right now. And, this isn't the best time of the year. The best time of the year just recently ended in mid-January, where we have about almost a 3-month period where the market tends to do its best performing of the year. So just got a lot of things kind of coming together. The fact that, we had the pandemic and the market rallied well over 100% in less than 2 years. I mean, normally, if you look at history, the market doesn't do that and just keep going higher. I mean, it really does just need a pause. And, we can pick the reason, call it, the Fed, call it the various variants of COVID, if you want, call it whatever. I mean, you can talk about the inflation. There's all kinds of things that we can point to, but bottom line is I just think the market needs a pause. And I think until we really reset our sentiment indicators and begin to see some relative strength in key areas like the growth stocks, I just don't think, I think it's gonna be really difficult for the market to go higher. So anyhow, I could just have a whole seminar just on that, but probably ought to get ready, get this thing started. You ready to go too? Everybody ready to go?
Let's do it.
All right, let's do it. So tonight we are going to look at the top 10 stocks for our portfolios. Every quarter, if you're new to Invested Central or, well, earnings beats, every once in a while, I still come up back to the Invested Central. I think it's just etched in the back of my head somewhere. But we were Invested Central for many years. We started in 2004. And then I think we made the switch over to earnings beats because it really was just more of what we were doing. We followed earnings a lot. I'm a CPA. I was in public accounting for many years. And so we're probably one of the few companies that looks at both fundamentals and technicals. A lot of times we look for fundamentals in terms of finding the stocks we want to consider buying, and then we use the technicals for actual entry. But anyway, we switched over to earnings beats probably back in maybe 2013, 2014, something like that. It's been a while. Yeah, I mean, we've got, earnings that are kind of up in the air. Some companies seem to be blowing it out of the water, and then other companies are really struggling. You get the Airbnb report from last night. I don't know, could have been a whole lot better than that. Expedia recently, really nice report. And then you got the other side, you got Facebook, which, talks about slowing growth. And it's really, we've seen kind of a shift in the market in terms of where we're starting to see leadership and where we're not. So as we go through and we pick these portfolios, we do it every 90 days. And we have 4 stock portfolios that we've been tracking. We have a 5th one that we've kind of started over the past 2 quarters. We don't officially track it. I'm really looking at it to see if it's something that I think is worthwhile continuing. And even though it hasn't performed well, I think the biggest problem is just the timing that we've had this portfolio. It's our earnings reaction portfolio that we started about 6 months ago. and couldn't have picked really a whole lot worse period to try to put together a portfolio of growth stocks, because the market just hasn't been treating growth stocks well. And most of these growth stocks are small and mid cap growth stocks, which have been even worse than the large cap growth stocks. So anyhow, on Monday, we'll be announcing the 10 equal weighted stocks that will go in each of our stock portfolios. Tonight, what I want to do is just simply talk about some of the things that I go through and think about in putting together these portfolios. And we may, take a little different approach this quarter than we've done in the past. I know with the model ETF portfolio, that's our only ETF portfolio. We do that in January, April, July, and October. The stock portfolios we do February, May, August, and November. And the reason the timing for the stock portfolios is we kind of wait until we get through earnings season. Most of earnings now have come out. And so once you get to about that 19th of February or the 19th of the second month of the quarter, that's normally when most companies have reported. And so that's the whole idea behind the strategy for picking that date. But both our model portfolio and all of our stock portfolios are really geared more towards growth stocks. I believe we're in a secular bull market. When you're in a secular bull market, history tells us that growth stocks are going to outperform the value stocks. Aggressive sectors will outperform the defensive sectors. That's been the history of secular bull markets. So that's why our focus is there. And when we first started doing these portfolios back in, I think the model portfolio we started in November of 2018, the idea back then and what we were trying to do was to show how if you take 10 leading stocks in 10 leading industry groups, and generally all different industry groups, so you are trying to diversify in different areas of the market, but only with 10 stocks, but you're taking the 10 leading stocks. The idea was that we would probably get, maybe 6 or 7 stocks that would continue to do really well. We might have, 2 or 3 that lag, but overall we would do well and we'd outperform the S&P 500. And so we started out with these portfolios looking to outperform the S&P 500. And we did that very successfully until heading into 2021. And over the course of the last year or so, we've had a couple of really bad quarters, this one being a bad quarter. And then, of course, the quarter from February to May of last year. And it was when inflation really started to take off, both quarters. That's kind of what's happened. Interest rates have moved higher, and both of those tend to have negative impacts on growth stocks. Now, the problem that we've had is that literally almost the day that we've announced the portfolios is the day that rotation switched. And so we have been caught in growth stocks for 90 days, 2 separate quarters now, where they have been largely out of favor the entire quarter. And we've never used stops. We want to try to, what we try to do with these portfolios is we try to appeal to folks who don't want to trade and don't want to have that trading mindset. Now, anybody who uses these portfolios and looks at them and that you can trade them, you can invest in them, you can do whatever you want. It's completely up to you. We're not registered investment advisors. We're not, managing your money. We're not telling you what to do. These portfolios, in my mind, are done for educational purposes to try to help teach how leading stocks and leading industry groups can help you outperform over time. Now, if there was one mistake that it was made, probably was making the assumption that we were going to be able to really hold our own with the S&P 500 every quarter. And I think ordinarily, and I think when we get back to a normal market, I think that our quarterly performance will probably stay pretty close to the S&P 500 if it's not outperforming it. But because of the skewing and the massive rotation, I mean, it's been violent rotation between growth stocks, value stocks over the last, I'm going to say 12 to 18 months. That has really made it difficult when you're just focusing on one area like growth stocks. So I just wanted to kind of set the stage there before we get going today on some of the things that I want to talk about. So let's go ahead and pull up the agenda for this evening. And this is probably going to be, I'd like to finish by 5:30 Eastern, which is 50 minutes. That might be a little optimistic, might take a little bit longer. I've got a lot of charts to go through and show you. But here's what we're going to do today. We're going to talk first about market conditions. And so that's going to just talk a little bit about the themes and what we're seeing in the market, what I think we might see over the course of the next quarter, because that's going to help set the stage for how we want to put these portfolios together. Then I'm going to go through and I want to show you a performance analysis, because I can sit here and say, well, this quarter wasn't good, this other quarter wasn't good, and all these other quarters were good. But bottom line, I'm going to show you not just our performance of our portfolios, but I want to show you some benchmarks that I think is useful and things that we need to focus on, because we're not really going to change our focus away from growth stocks. We might have a little bit of a focus away from growth, a little bit more than usual this upcoming quarter, because I still believe that we could be in for more of an inflation scare. I think interest rates continue to go higher. I think as long as that's on the table, we're probably going to see growth stocks struggle. So we might try to move a little bit away from some of those growth stocks, what we would normally consider growth stocks, like software and semiconductors and autos. I mean, Tesla and some of those companies have been tremendous growth companies. Renewable energy, tremendous growth area. But that is literally, hit or miss. I mean, it's either a great quarter or a horrible quarter. That's what seems to happen with that group. So we might venture away from that a little bit, but I'll talk about that as we go through. I do want to point out, though, the performance analysis that I put together, and hopefully you can see that I think what we do works over time. Then we'll jump into the strong earnings chart list. If you are new to earnings beats, the strong earnings chart list is where most of our portfolio stocks come from. We do have a strong AD portfolio where we don't have to have a company that's on our strong earnings chart list, but generally speaking, the companies that we put onto our portfolios come from our strong earnings chart list. And the only way you can get onto that strong earnings chart list is, number one, you have to beat Wall Street estimates as to both revenues and earnings per share in your latest quarter. Not latest 4 quarters, just in your latest quarter. We want to at least have that positive fundamental news underneath, kind of setting the foundation for a pick in our portfolio. Then the stock has to be doing something technically that we like. It either has to be a strong relative performer, or maybe its peer group has to be strong relative to the S&P 500, or maybe I just see a really strong AD. The stock itself maybe is going down, but maybe its accumulation distribution line is going up. There's got to be something technically that I can grasp onto. So it's got to meet both those, the fundamentals, also the technicals, and then finally it has to be liquid. So we're not going to be looking to add any companies that trade 2,000 shares a day. I mean, we want to have at least a couple 100,000 shares a day. So that's how you get on this list to begin with. Then we're going to get into the, we're not going to get into the draft, but we'll talk a little bit more about the draft, which will be held on Monday at, I believe we said 4:30. Maybe have to look at the schedule. Sometimes we do the draft a little bit later, but I think because it's a holiday, I think we decided we were going to do 4:30, but we'll definitely let you know as that draws closer. All right, so that is your agenda. So let's go ahead and get started here. And I want to first go through and just show you some of the charts that I think are really important and themes that I think we all need to be aware of. So we're going to start first with the chart I almost always start these webinars with, which is my big picture 100-year monthly chart of the S&P 500. I've spent many hours over the years talking about this chart, so I don't want to spend a lot of time. Basically, I believe we're in a secular bull market. So even though I've been talking bearishly in the near term, I keep saying, yeah, but just wait, have patience. We're going to have an opportunity. The reason I'm saying that, or one of the big reasons I'm saying that, is I believe we are in a secular bull market where we can have cyclical bear markets from time to time, but overall, we're going to go higher. And so if we do pull back, I think it's going to set up a great opportunity for another big move to the upside. So, if you look back, here's the pandemic. Here was the drop in the pandemic. Here was the drop with the trade war. Here was the 2015, 2016 consolidation, sideways consolidation and false breakdown. You go through these periods from time to time. It's not, when you get in a secular bull market, you don't go up every day, every week, every month, and every year for 20 years. You still go through periods where you have pullbacks. 1980s and 90s, we had the 1987 market crash. At the time, that didn't feel like a secular bull market was in play. But looking back, you can see that was just within the parameters of an extended long-term secular bull market. Now, looking back at the pandemic, everybody was panicked back in March 2020. But now as we look back, we say, my gosh, it was such an opportunity. Fortunately, we were believing we were in a secular bull market at that point, and that's what helped us outperform, especially in the year 2020. We had an amazing year in 2020 because we didn't buy into the theory that we had a long-term secular bear market taking place. Cyclical bear markets tend to be very quick. They can be as short as 30 days, like the pandemic, or maybe more normal is maybe around 90 to 120 days, something like that. But I think we could be in one of those periods right now. You look back to the 1950s and 60s, there was another secular bull market, but you can see plenty of pullbacks along the way. We had multiple recessions. A recession doesn't have to occur in a secular bull or bear market. A recession can just be part of a cyclical bear market and still be in a long-term secular bull market. So I think there's a risk that we could hit a recession later this year. I'm going to see what happens, but if the Fed raises 7 times, I think we're going to have a recession. Maybe that's what is needed to calm down inflation, but 7 interest rate hikes is probably going to throw us into a recession at some point down the road. Now, the market may anticipate it. We may, lose the necessary points and percentages long before we bottom, or long before the recession has been confirmed. But I think it's still a possibility later in 2022 that we could be faced with a recession. Just depends on how this all plays out with the inflation and the interest rates. I personally think inflation is going to peak probably in March or April. And from there, I think if the Fed gets it wrong and they keep raising rates, I think that's going to possibly trigger the recession. I think if they get it right and they cut off the rate hikes before they do too much damage to the economy, then I think we could avoid recession. But anyway, there's the long-term look. You can see the secular bear markets are just extended periods, usually 10, 12 years of going nowhere. Up, down, up, down, up, down, but basically over the entire period, you go nowhere. So anyway, always like to start off with that because you need to know this is whatever happens this year, it's part of a bigger picture look. And I'm very bullish on the big picture. And I know I got an email, I don't know, probably 3 or 4 months ago from someone. I don't even think I remember of Earnings Beats, but they made some comment like, you need to commit. You can't be bullish and bearish. And I'm thinking, why? Why can't I be long-term bullish and short-term bearish? What's wrong with that? What's wrong with thinking ahead of time that if we get a pullback, that's a buyable pullback? Do I have to be bullish every single day? So anyway, I thought that was, I don't know, maybe very short-sighted way to look at things. I think big picture, we're bullish. Short-term, we've gone up a lot. We need a pullback. Why do we need a pullback? Because look at this is a 1-year moving average of the equity only put call ratio. We were at a level that we've never seen. Well, going back, since we've had the equity only put call ratio, we had a 1-year moving average of the equity only put call ratio down around 0.46. It's too low. We went up over 100% on the S&P 500. Anybody who started investing in the stock market, there are plenty of folks who started investing after the pandemic. Anybody who started doesn't know what a bear market looks like, doesn't know what a correction looks like. They've just found out. But everybody was so bullish in the options world. We need this to move higher. And if you take a look at where we have bottomed in the past on the equity only put call ratio right here, that was in 2006, right ahead of a really tough market. Here, 2011, very bullish. And for the next year, 15 months, we had problems going anywhere. Wasn't a big sell-off. We were just sideways consolidating. There was some selling in between, but for the most part, we just didn't do anything. And then 2014, we got very, very complacent, very bullish again in the options world. And look at the next 2 years. It was nothing. And so here we are, and we're just starting to turn higher. I mean, I feel like we're in the early innings, maybe third inning of what could be a resetting, significant resetting of our sentiment. The higher this goes, the more fearful we get. How do we get more fearful? The market goes down. So I think we need to see the market break down even further to help us reset this equity only put call ratio. The beauty is that once you reset, once you get the number up to wherever it needs to go, and I don't think we're going to go all the way up here. This was in a secular bear market. So there was already a lot of fear. So I don't think we get this high. Probably not even this high. I think we could get back into the 0.660, the 0.65, like somewhere up in here. And I think if we got back to that level, I would start feeling much, much more comfortable about getting into the market. But in order to do that, to get that fear ratcheted up a little bit, we might have to go down to 3,500, 3,800, something like that over the next few months. And I wouldn't be surprised to see that. Once we get there, I would be buying up my favorite growth stocks, whatever it is, whether it's Apple, Microsoft, Tesla, Google, maybe you have some small cap, maybe it's Zoom, maybe it's, I don't know, Shopify, which has been getting crushed. Datadog is another favorite of mine. Anyway, all these different companies, these growth companies, I think could set up to be absolute beasts going forward. And I'm saying this from not just looking at the charts or hoping that we resume our bullish move to the upside. I'm also looking at it from a CPA perspective, because I did valuations. I know what happens to valuations when you start projecting higher inflation rates and higher interest rates. Valuations on growth stocks are absolutely crushed. The other companies like consumer staples and things, those companies continue, their profits are pretty solid, whether you're in a runaway growth market or whether you're in runaway inflation market, you're still going to have very similar earnings trajectory with consumer staples names. Growth stocks are completely different though. When the prospects look great, rates are coming down, inflation's coming down, that will send growth stocks valuations through the roof. But when the opposite is happening and we're starting to see the inflation tick higher and then the interest rates start going up, that's what triggers the huge selling. And that's why we've seen many of these growth stocks get hit so hard over the course of the last year. And I still think there could be a little bit more downside action. Got some really interesting charts I'm going to show you. But anyway, I thought that this is one that I always like to talk about. So here's the S&P 500. And you can see the last 2 years. So we were down here at 2191 and we went all the way up to 4,800. And we did that in about 21 or 22 months. I mean, that was a crazy move. Now you do have to keep it in perspective. We're coming off a panicked low. Before the panicked low, we were probably around 3,300. So 3,300 to 4,800 and change. I mean, we're getting close to a 50% move in less than 2 years. Even if we ignore the huge drop in the pandemic, that's still really good move to the upside. Now, here's the problem I think we have right now, or one of the problems. The S&P 500 kept going higher in 2021, even though growth stocks relative to the S&P 500, and I put two different ratios on here. Growth, the Dow Jones US growth stock index relative to the S&P 500, and then the IWF, which is an ETF that tracks large cap growth stocks. So both of these, and you can see they're very similar. Their charts look very similar. As we went higher in the S&P 500, you can see that the growth stocks rolled over on a relative basis. And yet we kept going higher and higher after that. So I know it would be easy to look at this now and say it's no different. This is no different than what we saw in September and October of 2020. We topped on the growth stocks. We started rolling over. The S&P went through a little period and then we went back up without growth stocks outperforming. So you're like, why can't we do that again? We already did it once. Well, here's the difference. Back in 2020 and 2021, growth stocks were going down on a relative basis. But if you go down here and look at the actual absolute performance, growth stocks were still going up. Technically, nobody was selling. I mean, they may not have been outperforming, mostly because of inflation, but the group was not downtrending. It was uptrending. It just wasn't uptrending as much as the S&P 500. So these stocks were still helping to keep the S&P 500 in an uptrend. The problem now is that as we've rolled over in the S&P, maybe you might look and say, well, it's very similar to what happened here, and we're just going to go right back up, and maybe we will. But I think it's different this time. The reason I think it's different is right here, as we roll it over, we're seeing growth on a relative basis underperform, just like we did, last time. But the difference is, look at the absolute low. We already went down and moved to a 8-month low in the growth stock index. We've bounced back up. I think we have a right shoulder in play. We have a down sloping neckline, left shoulder over here, right shoulder over here, and that's also down sloping. This looks to me like this group is ready just to roll off the table to the downside. And if that happens, the S&P is not going higher. So if you want to look for the group, in my opinion, that really holds the cards here, it's this chart right here. The Dow Jones US Growth Stock Index. If this confirms a breakdown of this neckline, I believe the S&P 500 is very likely to go down into the 3000s. So keep an eye on that chart right there. The XLY XLP. I mean, if you look back, the XLY XLP continued going higher. That's the ratio that I look for sustainability. As the market goes up, I like to see the XLY XLP go up. And that's what was happening. We were going up or we were consolidating. We were definitely not downtrending at any point in this ratio. Now, as you look at the end of the year, as we made that final high, in addition to the growth stocks starting to underperform, we also saw a huge drop in the XLY XLP ratio, consumer discretionary versus consumer staples. Not only that, but we've gone down now to a low that we had not seen since back in 2020. This isn't just consolidation. This is a downtrend. So I'm seeing multiple signs, in addition to the sentiment, which we already went over, that I believe needs to be reset. But I don't see the same makeup of this move that we saw back on the S&P 500 here, where we kept going higher and growth stocks continued to support us, and the XLY XLP continued to support us. We don't have that now. So you better at least be recognizing the possibility that this is going to go on for a little while longer. The good news is that if this is a cyclical bear market and this breaks down, it will probably move very swiftly to the downside. It's not going to go to 4,200 and then back up to 4,300 and then the 4,175 back to 4,250. It's probably going to break. If the S&P 500 breaks at 4,300, it's probably going to be within 5 to 10 days that we're going to be looking at 38, 3,900. I would not be surprised to see 500 points off of the S&P 500 very quickly. That's the way bear markets work. They don't just slowly go down. They might start off slowly going down in a secular bear market because conditions are much different in a secular bear market. But in a cyclical, usually it's very swift. As I mentioned earlier, most cyclical bear markets don't last more than about 30 to 90 days, maybe 120. We started this, if this is the start of a cyclical bear market, we're already 45 days in. So I'm thinking, I still believe that we could put a bottom in maybe March or maybe early April. We're going to watch when those inflation reports come out, the CPI, but they'll probably come out sometime around the 10th or 12th of March, and then again, same time in April. And I think one of those two reports, probably the April report, is going to all of a sudden show that inflation came down. And if that happens, I think your bottom probably will be in at that point. So I'm just speculating. But again, as we're trying to put together a portfolio, I'm trying to think, okay, what's the most likely scenario here over the next 90 days? And I'm not very bullish. I think to just go ahead and put all growth stocks in right now probably isn't the best idea. I think maybe we mix a little growth with value in our portfolios. And then if things change, I'm going to leave the door open for possibly mid-quarter changing our portfolios. If I think we bottomed, I'm not going to wait for another, 30 or 45 days of underperforming before we can go put growth stocks in our portfolio. So I think that's probably the change we'll make, is that we'll keep open the possibility throughout the quarter. If things begin to change or begin to see some signs that we want to be more aggressive, we may replace just some of the stocks. We may replace them all, but I'll leave that open. All right. And then, by the way, down at the bottom here was the XLY. And the XLY, not only on this ratio moving lower, but on an absolute basis, we moved down to a multi-month low, probably about 6-7 month low when we hit that January low. So, that's an aggressive area of the market. Technology, aggressive area of the market. If these stocks, these growth stocks, large cap, do not right their ship and start to turn back to the upside, the S&P 500, in my opinion, is not going to go back higher. There's just too much weighting and when I say weighting, I'm talking about W-E-I-G-H-T, not W-A-I-T. Too much weighting. They're too heavily weighted. Technology stocks and other growth stocks, Tesla, those types of companies are too heavily weighted in the S&P 500. We've got to have support from those stocks, at least on an absolute basis, even if not on a relative basis. All right, consumer price index. Here is the total each month, just going up, up, up. Here was the 12-month rate of change. You can see just breaking out above these prior highs. And I think this goes higher at least for the next couple of months. So I would not be surprised if we maybe push 7% on the core CPI rate. Another look at the core CPI. This is breaking it down just over the last 3 months. The chart I just showed you here, this goes back in the early 1970s. This is a 50-year chart. This one now is just a 3-year chart. Here's the monthly readings. And I use a candle chart because the open, high, low, and close are all the same. So you can actually see the distance that these are moving higher. But the next 2 months coming out, January and February, are going to replace January and February February and March. So the next 2 months will be February and March, and they will be replacing February and March of this year when we didn't really have much movement to the upside. So chances are, if the inflation remains, 0.5% or higher on the monthly basis, we're going to see the annual rate go up because it's replacing smaller gains from earlier in the year. But when we get to April, look at the jump that we had in April of 2021. We're going to lose that jump. And look at the next 3 months, big jumps. Those 3 will start coming off, and they'll be announced, April, May, and June. So when these come off, I believe we're going to see inflation moving lower. And I've got a chart I'm going to show you next that shows you when inflation peaks and starts to roll over. That's usually very, very positive for growth stocks. So this chart is, again, the monthly core CPI. Here's the 12-month rate of change. And then the charts below here, this is growth stocks, large cap growth versus large cap value, mid cap growth versus mid cap value, small cap growth versus small cap value, and then the NASDAQ versus the S&P 500. And what I'm doing is the first part is the aggressive part of the ratio. NASDAQ's more aggressive than the S&P 500. Growth stocks are more aggressive than value stocks. When you see peaks, and I have these blue dotted vertical lines right here at peaks on the inflation rate. And if you look at the peak, and as we start to roll back over, now this was back all the way in the 1980s, and we didn't have these indexes back then. So that's why I added the NASDAQ versus the S&P 500. And you can see as we rolled over and started moving lower in inflation from the peak, you can see almost exactly at that time, the NASDAQ started to outperform the S&P 500. And then the red dotted line shows where inflation starts to spike again. Here's a period where we spike, and the aggressive area, NASDAQ versus the S&P, this ratio is going down. Now we fast forward because most of this other period, I mean, we were downtrending, and throughout that entire period, for the most part, the NASDAQ was soaring until we got to the dot-com bubble. I mean, we were going up. The growth stocks were doing much better while inflation was coming down. Now, in here, we're kind of in that target range, straddling that 2%. But throughout this whole period, the worst inflation got was in 2006. Right here, got up to about 3% core CPI. And if you look at that, and we started coming down from 3%, and look at the large cap growth going up, mid cap growth going up versus value, small cap growth going up, NASDAQ versus the S&P going up. Now, what happened when we started to spike, had this huge spike? And again, I didn't really look here because this, to me, going from 0.5% to 2% inflation is not an inflation problem. That's actually the target level of the Fed. So here, this was actually the breakout that we saw in 2021 on inflation. Now, large cap initially did pretty well. And I think part of it is because they're probably recognized as having more pricing power. You know, Apple and Microsoft, if Apple raised the price on their iPhone, do you think their customers would go away? I don't think so. I think that there is such loyalty to Apple, to that brand, that if inflation hits, I don't think that it's going to be nearly the impact for Apple. I think the bigger problem for Apple is that now we're starting to raise interest rates. We didn't raise interest rates last year. So, you know, the Fed was talking about, well, it's, transitory, and we don't, we're just going to kind of watch it. We're not really going to raise rates. They didn't start, they didn't start cutting back on their purchases of the treasuries. All of that was different than what we have now. Now we actually have interest rates rising. Why is that a difference? Well, future growth of Apple, any growth company, when interest rates start going up, they will immediately take a value hit, because the value of future earnings growth or future cash flows, that the present value changes as interest rates go up. It makes those future earnings and future cash flows not as valuable. So I think the difference this year is that there's the threat of the higher interest rates. And that's why I think we're starting to see these large cap growths get hit when they didn't last year. Not to the same extent small cap did. I mean, you can see starting last year, we topped on the mid cap right here. This was back in late 2020, early 2021, right as we started taking off. That's when we topped mid caps and mid cap growth versus value and small cap growth versus value. Large cap was able to keep going. I don't think that's going to be the case this time with interest rates going up. And that's what I think is the difference. And I think we're already seeing it in that chart I showed you, where not only are we going down on a relative basis, but growth stocks, large cap growth is now going down on an absolute basis as well. And that is the difference. And I think that's why the S&P does not go higher here. I do think they will go higher, because I think the Fed's going to put they're going to put brakes on the interest rate hikes, in my opinion. Once we top an inflation, why are you raising rates? If the inflation starts to come back down, there'll be no reason to raise rates. In fact, I wouldn't be surprised by the end of this year if the Fed has a rate cut. If they do raise and they raise too many times, I think you could see a rate cut down the road, because inflation comes down. And I think if they raise too many times, we start to see signs of a possible recession. And that's when I think they start thinking about cutting again. We'll see how it all plays out. but that's my best guess at this point. And then there's the NASDAQ versus the S&P 500 also turning down just as the inflation started to rise. So I think all of this makes pretty good sense to me. I mean, I was kind of confused for a while with the growth stocks, large cap growth continuing to perform well, but that helped the market stay aloft. Now I think we have a different story. All right, here's the head and shoulder top on the S&P 500. You better be aware of this one because we're in a very unstable market. When you look at the VIX, volatility index is still up to 25. What do you think is going to happen if we lose a major technical support level? I think we could see the VIX go up back to that 39 level, maybe even scare the heck out of everybody. We might see the VIX into the 40s to mark that next bottom. Be careful. Watch the neckline at 4,300. And the fact that those large cap growth are there, you don't have this equal, when I'm looking at closes here, we're pretty darn close to equal from left side of neckline to the right side. The shoulder, we're actually a little bit higher on the S&P on the right shoulder. The NASDAQ, everything's sloping to the right. It's sloping down. That is a really bearish look to me. So if we break down, just be careful. Remember this webinar today. And by the way, I'm not just talking bearishly now. I was talking bearishly 6 weeks ago. If you haven't been following me over at Stock Charts with my blogs, and if you haven't been a member of Earnings Beats for the last 45 days and you're not aware, I was posting articles at the end of December before we even topped on the S&P 500, talking about the fact that defensive groups were leading, talking about the sentiment issues that we had. There were a lot of issues, the XLY, XLP ratio rolling over, lots of signs, and that's when you have to take precautions. All right, here's another chart of the S&P 500, and here is that last ditch move to the upside on the S&P, and there's that XLY, XLP ratio. We topped in November there. When we broke out in November here, we actually broke out the XLY, XLP. Everything looked good. And, I wasn't bearish 3 months ago. I didn't turn bearish until we made this last high in December. We had a short-term, I remember we had some short-term issues with the VIX back in mid-November. But the bigger picture signals that I was getting that made me turn more bearish didn't occur until December, the latter part of December. And here was one of them, breaking out and the XLY, XLP just falling off the table. This is my sustainability ratio. And it wasn't looking like that move was sustainable. And now we can see it's not. All right, how about the channels that we're in right now? This is something to watch. We've got options expiring this Friday. And we had a webinar last night for our members. I think there is a reasonable chance in the near term that we go higher. Would I be shocked if we wake up tomorrow and futures are down 500 on the Dow? No, because I think the short term, the next, few weeks to maybe a couple months, I think we're going to see more downside action. Everything's pointing to me that we're going lower. So to me, that's the path of least resistance, longer term or intermediate term. Short term, if we move up for the next couple of days, we still could be in this down channel, and it will help save market makers literally billions of dollars. So a little bailout, for the market makers. Of course, we're all feeling sorry for them, right? We should take out a collection plate. Being very sarcastic if you can't tell. Anyhow, I think that this downtrend, you want to watch this channel. If we can break out through the channel, which will come in and intersect probably close to about 453 or so on the spider. If we get up into the low 450s, that's when we're going to be very close to that channel resistance. If we can get through that, then we've got the double top that we have to negotiate up near 457.5, 458. And if we can get through that, then I will be reevaluating what I'm talking about in terms of being more bearish, because it could be that we just simply sideways consolidate for a while as opposed to downtrend. That would be the sign to me, a move through that double top that I'm going to have to sit down. And now if we move through the double top and the XLY, XLP are still going down, I'm not going to trust that breakout. But if all of a sudden some of the other things I've been talking about turn back up with that move, then we've got to recognize it. Technical analysis, you don't just make a call and then say, I'm sticking with this for the next 6 months, no matter what. I mean, if I had done that back in November, I think small caps broke out. I was very bullish when small caps broke out on an absolute basis. And if I had just said, hey, I'm bullish and not changed my mind and been stubborn about it, I would be absolutely getting killed in the market right now because of the huge drop. You've got to change as the market changes. And I think we're really good at that at Earnings Beats. All right, QQQ, same thing. I mean, you can see probably around 360 is where we'll intersect with that channel line coming down. But it certainly looks like we are in a channel to the downside. So until proven otherwise, I'm going to respect the channel resistance. All right, we already went through that. So let's move. Well, we're still in the market conditions. Still, I want to talk some more about market conditions. But this one, you know, there's still some talk about Omicron. I want to put the Omicron variant to bed right now. The Omicron, the market is not concerned at all with the Omicron variant of COVID. The charts tell us that. I don't need the media outlets. Of course, they're going to focus on anything that's negative. I want to know if Wall Street's putting their money to work based on fearing COVID or not. And right now, I would say COVID is the least of their worries. That has no impact right now on what's happening in the market. Zero, as far as I'm concerned. And just look at the companies that were benefiting. You know, you look at like Moderna, you know, benefiting from the COVID, the vaccines and everything else. That stock has been cratering. You know, it was 400 and something. Now it's 150 or whatever. That ought to be one sign right there. But let's just take a look. I put a chart list together. I have a chart list together here of COVID and the impacts back in 2020. This chart ends on March 23rd, 2020. This is where we were heading lower during the initial stages of the pandemic. That was the drop. That was the cyclical bear market. You're looking at it right there. From February 19th to March 23rd, 1 month. Month and a few days. I wanted to go through and just show you on these charts what happened to some of these companies that were negatively impacted by COVID. So here we've got the NASDAQ. The rate of change was 29.5% right here. That's a 25-day. That's how many days were involved from February 19th to March 23rd. So I did a 25-day rate of change. AD line going up on the NASDAQ. We went down in price, but the AD line went up because we had a lot of accumulation. Some of these candles, even though we finished down some days, we had really nice accumulation. So that's what kept the AD line up. But let's go ahead and go through some of these charts. Next up, airlines. So 29% down on the NASDAQ. Airlines were down 58%. Obviously, airlines were hit very, very hard by COVID and the AD line going down. Aerospace got hit very hard. We lost 59% over those 25 days. The AD line was going lower. Again, this was definitely an area that the market was saying you want to stay away from. How about recreational services? Think, something like Royal Caribbean, cruise lines. Here was the big drop. We went down over 25 days, 67%, way more than the NASDAQ. Remember, NASDAQ was only 29%. AD line falling off the table. Travel and tourism. Couldn't travel. I mean, travel was heavily restricted, still is to some extent, although not nearly as much as it was. But travel and tourism down 45% in those days. Look at the AD line going down to a new 52-week low. Clearly distribution taking place. S&P 500 was down 33.81%. American Airlines. Now I got a bunch of individual stocks. I'll just show you this one. Accumulation distribution, look at it getting killed. 65% American Airlines was down during that period. So that was when COVID just scared the heck out of everybody. And Wall Street was treating these areas and these companies much harsher than it did the overall market. I think just from looking at these charts, I think it's pretty clear. Now let's go to the Omicron. I'm going to bring up some of these exact same charts, but I'm just going to look back since, and I've got a 32-day rate of change, which is just what we've been seeing now in the last, well, in 2022. That's how many days we've traded so far in 2022, 32 days. So here's the NASDAQ. NASDAQ come down a little bit on the AD line. NASDAQ's down 9.72%. Remember, NASDAQ did better when COVID, because a lot of the growth stocks that were on the NASDAQ still did extremely well during COVID. Wall Street, is pretty smart. They were moving their money into the NASDAQ on a relative basis and into those growth names back, as soon as the pandemic started to kick in. So everything was gapping down, but then the really good, the growth areas that did well in 2020 were being accumulated, while airlines and cruise lines and those types of companies were being sold off hard. Now we're into Omicron, the last 32 days. And so the NASDAQ down 9.72%. Let's look at some of these same charts. Airlines up 11%. So airlines have outperformed the NASDAQ by 20 percentage points so far this year. Aerospace up 7%. So outperforming NASDAQ by 16 percentage points. Recreational services right now up 9.6%. So 19% outperformance over the NASDAQ. Travel and tourism up 5.33% this year. Again, versus the NASDAQ's 9% loss. S&P 500 actually down 6%. Why? Because it's the growth names that went up during COVID. They're going down during Omicron. Money is actually rotating into areas that are not weighted as heavily in the S&P 500. So all these charts that I'm showing you where airlines are going higher and cruise lines are going higher and travel and tourism is going higher, they're not big areas. They don't have heavy weighting in the S&P 500. So the S&P is going down because of those large cap growth names. American Airlines. So this will be the last one. I showed you American Airlines back during Omicron. Now look at it, or during COVID. Now look at it during Omicron, 4.79% gain. Why are airlines going up? Why are travel stocks going up? Why is aerospace going up? We still got lots of cases. There's still lots of Omicron going around. Market doesn't care. Stock market doesn't care right now. So I'm not letting that impact my theme at all. I will not make any decisions whatsoever in the portfolios on Monday based on Omicron. I think it's in the rearview mirror. Wall Street is saying it's in a rearview mirror. Now, does that mean that we're not going to have another bout of Omicron in the fall and the people aren't still going to get sick? And hopefully, we don't have a variant that gets worse or has worse symptoms. But right now, and really even since November when Omicron was first spotted, we had a little bit of pullback initially. And then there's still a lot of folks saying that, oh, we're going down. It's Omicron. I don't think it has anything to do with Omicron. Again, if it was Omicron, why would airlines be going up? Give me one good reason. If Omicron was a problem, why airlines would be leading the market right now. Omicron's not a problem. So from a stock market perspective, ignore it. All right, last thing I want to show you in this market conditions is just some areas of the market that I think, are starting to look so much better. I'm going to pull up first the aerospace. We just talked about aerospace, and I'm going to go out a year. Actually, let's just pull it up here. Okay, so we're right up against a resistance that we've been struggling to get through for a while. I mean, we're not far from breaking to about an 8-month high on aerospace. Meanwhile, the S&P 500 is down significantly, still trading down below its moving averages. Aerospace is doing much better on a relative basis. Look at the volume coming in these last couple of days as it moves up. I think we're going to get a breakout. How about hotels? Looked at the hotels lately? This is another one that really struggled with COVID. With Omicron? Not really. This is about when the Omicron news came out. It was right around the early part of November. And initially we went down. Look at where we are now, breaking out above the early November highs. Is Omicron a problem? I don't think so. But we're getting a good breakout here, which is nice. That travel and tourism group I just talked about just made a breakout to about a 3-month high. Nice breakout there. That group looks pretty good. How about in the financial area? The DJUSIF, full line insurance. We've been trending higher, just recently made a breakout. How about defense stocks? Couldn't have been much worse area than defense recently. Well, we're now trending higher, trying to stay above that 20-day EMA, not far from moving to a 52-week high. Pretty good action there. Life insurance. Just recently moved to a new high. So these are all areas that underperformed in 2020 that are actually starting to show some really nice strength, beginning to break out. And so having some of these companies in our portfolios probably might not be a bad idea, maybe to hedge a little bit. If we're going to keep growth stocks, maybe we still want to mix in a few of these companies to give us a little bit of a hedge. And then if the market turns around and growth stocks start to lead again, we can always replace those down the road with more growth-oriented companies. But these are taking over for areas that had been doing really well, like software. Software downtrending. This doesn't look anything like full line insurance, which just broke to a new 52-week high. Software has been downtrending now for 3 months. Even with today's action, we saw the market finish up. Software was down 0.5%. So on a relative basis, these stocks are just, there's just too much negativity in them right now for me to be bullish, the S&P 500. And that could change, but I'm not going to assume it's going to change based on all the things we've talked about tonight. Semiconductors, down 6 points today. Coming up off the bottom recently, but still we have a downtrend in play, well off the earlier high. So this is a group that's not looking so great anymore. How about autos? Tesla, been struggling. It's been taking autos right down with it. Can't get back through that 20-day moving average. Got to at least do that, to start turning some heads and maybe getting some technical buyers to jump in. How about renewable energy? I mean, renewable energy looked like it was taking back off again October into early November and then right back down again. So, short term, we're barely off the recent lows. And if growth continues to be a problem, we're probably going to take another move lower in renewable energy stocks. Anyway, so that's what I had for market conditions. The rest of these should go a little bit faster. I'm going to go now, and I want to show you this performance analysis. I think this gives us a lot more perspective on what we've done, what we're trying to do with our portfolios. What we have here is, I did this since 12/31/18 or January 1st, 19. So we're looking at the full year of 2019, 2020, right here, 2020, 2021, and then so far in 2022. And I looked down here at the bottom, we've got our portfolios. And of course, the model portfolio, put some asterisks in here because they all, their inception dates were different with the exception of the aggressive and the income. They both began on May 19th. And yeah, May 19th, 19. And then Strong AD was May 19th, 20. Model ETF was 10/19/20. And then earnings reaction was 8/10/21. So the model portfolio is the only one that we've had where we've had 3 full years and now into our fourth year of results. The aggressive, the 3rd year will end come May 19th of 2022. So we still have another quarter to go. So as you go through and look at this, I pulled up the major indices, key growth and value indexes, and then some popular growth ETFs. ARK, the ARK funds, Kathy Wood, she had a tremendous track record in 2019, 2020, and then 2021, 2022, obviously took a devastating hit, but she's still outperforming the S&P 500 over the last few years. I know there are a lot of critics of hers, but I don't think it's her fault. I think it's the theme. She's a growth investor like we are. And when you're in growth stocks and they're out of favor, guess what? you're not going to do very well. But when growth stocks are in favor, look for some significant outperformance in the different funds, ETFs, portfolios like ours, where we focus on growth stocks. I would expect to outperform the S&P 500 by a wide margin. And I would be disappointed if growth stocks do well the next 3 months and we, end up switching over to growth-oriented portfolios and we don't outperform. I would be incredibly disappointed by that. I mean, it does happen from time to time, but not to the extent that we've been seeing. I mean, this has been this quarter and then also the quarter from February to May of last year, just absolutely brutal quarters. But anyway, each year went in and put the total or put the index value or the ETF value at the end of the year, and then compared the performance for each full year under the major indices, the growth versus value, the popular growth ETFs, and then our portfolios. And I just wanted to point out a couple things. When growth, look at 2020 or even 2019, growth was beating up on value pretty good. It crushed value in 2020. And look at how the NASDAQ outperformed these 2 years. 38% versus S&P 28. NASDAQ 47% in 2020, S&P 16%. Massive outperformance. But once we started to see the growth versus value start to balance a little bit more, and you can see small cap value crushed small cap growth, mid cap value was almost 10 percentage points above mid cap growth, and then large cap growth was the only one that held up. And you can see that made it a little bit more difficult for the NASDAQ to outperform in that environment. And now this year, 2022 so far, the value stocks are basically close to break even, while each of the growth indexes are down 10 to 11%. And NASDAQ is down 10%. S&P outperforming. NASDAQ's your more growth-oriented, more aggressive index. Now, the large cap is taking a hit more so than the S&P mid cap and small cap. You can see that right here with these, first month and a half of the year. So definitely there's a little bit of a skewing there. Now look at the popular growth ETFs. So ARK, the Genomic Revolution, ARK Innovation, and ARK Web, ARKG, ARKK, and ARKW. Many of you probably follow IBD, their Innovator IBD 50 Index, FFTY. These are four that I think, what we do is probably very similar to what they do. It's not going to be the same. We're not going to perform the same, but this is, when they do well, I would expect that we will do well. When they don't do so well, chances are we're probably not going to do very well. Take a look though, from 2019 through 2022 at how we've performed. So if you look at the growth areas in 2019, 25 to around 40% in that ballpark was ARK and Innovator IBD 50. NASDAQ was 38%. Growth stocks 35, 32, and 29. Our model portfolio was up 52%. And the reason it's bold and in bigger font size is because it's the best of all of these in this column. So I did that for each one of these, did the best. 51, almost 52% beat everything in the category, or all of these different benchmarks in 2019. And quite honestly, not even close. We were 12 percentage points above the next closest, which was the ARK Genomic Revolution, ARKG. Now, in 2020, this is when the NASDAQ did really well. Look at growth versus value. Absolutely just trouncing value. Look at the ARK funds, 180%, 152%, 157%. IBD, only 18%. I don't know what happened there, but they were off a little bit. Our model portfolio, now we didn't beat ARK that year, but model portfolio doubled in 2020 after going up 52% in 2019. So again, when we get strong growth performance, I believe we're going to do well because we're picking leading stocks and leading industry groups. I think they are set up to run when they are in favor, when growth stocks are in favor. You move on to 2021. Everything changed. And I remember at Market Vision 2021, early January, might even been in December 2020. I think we might have done that one before the beginning of the year. And I remember saying that to me, the biggest issue was going to be rotation in 2021, not knowing when those value-oriented stocks were going to come back. Well, they started coming back in pretty good force, and it resulted in growth not doing as well, certainly not killing value like it had the 2 previous years. And and many of the small cap growth and mid cap growth, which we do usually have quite a few of, they underperformed considerably. And so when you're into areas that are underperforming, this is what happens. The ARK funds got hit pretty hard. Innovator IBD 50 was up 12%. That wasn't too bad considering what had happened in the market, the rotation that took place. Our model portfolio was only up 2%. So if you started investing in our model portfolio in 2021, you would have been saying, hey, these things are no good, because you're only as good as your last pick in the stock market. I realize that. But it was the theme. The theme made it very difficult. Now, our aggressive still did really well. Our aggressive in 2021 was better than any of these other indices. So 2 out of 3 years, one of our portfolios was the best in, among all of these different benchmarks. I think that's pretty strong, considering that in 2021, the model and the aggressive portfolios were the only ones. Oh, no, I take that back. Inception date on the income and strong AD. Okay, we had full years here on the income and strong AD. Income did pretty well, 23%, kind of holding in with the kind of the overall market. But aggressive, that was really impressive for the aggressive to do that well. Now we're in 2022, and this is still part of that quarter where we have just not done very well. And you can see NASDAQ down 10%. This is through the close yesterday, by the way. I didn't have time to update this for today's close and still start this at 4:30. But you can see that was down 10%. Growth, large cap growth, mid cap growth, small cap growth, all down 10%. The ARK funds, 18, 20, and 18%. Innovator IBD 50 down 16%. While we didn't exactly have a great start to this year, I think we're hanging in pretty well considering the overall market. And we're doing better than these other growth ETF peers that I put in here. So I think, this quarter, it's not been good. But with all things considered, I don't think it's been horrible. And you might disagree, especially if you've been investing and you're watching the S&P 500 go up and the model portfolio going down. I mean, I understand, I get it. It's not great performance, pretty bad on a relative basis. But when you look at what we invest in, and then you look at what those themes looked like over the last 14 months, I think it's pretty easy to understand how the underperformance occurred. Now, if you think that growth stocks are just going to continue to underperform for the next 10 years, I would say you might want to stay away from our portfolios. Probably not going to do well. But I don't think that's going to be the case. I think growth stocks are going to return. I don't know if it's going to be this quarter, but if it's not this quarter, I think next quarter, starting April 19th, is going, or May 19th, that's when the next draft will be, our stock draft. But May 19th, I think, could be very good. And especially as we get toward the latter part of the year, I expect really big returns from growth stocks. The last thing I'll point out is just cumulative. So the model is the only one that really can be compared to all of these because it's the only one that has been in existence since the end of 2018. The aggressive came into being on May 2019. So it missed the first 4.5 months of the year. But even after missing 4.5 months of a pretty good year, the aggressive over the last 3 years, the aggressive is the top performer of everything tracked here. The ARK funds, even with their great years followed by their not so great years, the ARK is 50%, 53%, and 70%. Our model portfolio is 75 and our aggressive 80. Look at the Innovator IBD 50. It's only up 10%. I was really surprised when I calculated that. Throughout this whole thing, it's only been up 10%. I mean, S&P 500 has been up 38%. NASDAQ's been up 67%. So I would be at least, in growth-oriented stocks, I mean, trying to keep up with the NASDAQ over a longer period of time. If you can do that or beat it, I think that's saying a lot. And we've been through a lot over the last 3 years. I mean, we've had the trade war. We've had the pandemic, 100-year pandemic. We've had racing inflation that we haven't had in 40 years. We've had what now looks like rising interest rates. We've had crude oil go from negative to almost $100 a barrel throughout this period. I mean, it has been a crazy 3 years. And yet, when you look at the end of it, the two portfolios sitting at the top are our two portfolios. And I'm pretty proud of that. I know we've had a rough last quarter, and I know we had a rough February to May last year. But again, when the growth stocks go out of favor, and they were out of favor the entire quarter, both of those quarters, when they go out of favor, we're not going to do well. And I think going forward, that's what you should be thinking. If there's one thing I've learned about our portfolios over the last 3 years, it's that we're only going to do as well as the growth stocks do. If growth stocks are out of favor, we're going to struggle to outperform the S&P 500. We're probably not going to. If growth is in favor, I think we have the opportunity, based on what we do, looking at fundamentals and technicals, I think we have the opportunity to really perform well over an extended period of time. If I'm right about being in a secular bull market for the rest of this decade, I think that our portfolios are going to shine. That's my personal belief, based on how we select them and based on what I think leads the market. And just in case you're wondering, because I did get this question, I always show that long-term 100-year monthly chart of the S&P 500, and on there, I'll usually show the sector performance since the secular bull market began, and I always show how the NASDAQ, outperforms the S&P 500, and I show, the XLK and the XLY performing well. And there was a question that asked me, how do those companies do, or how do those sectors do? How did they do back in the 80s and 90s when we had the last secular bull market? And while we don't have the XLK and the XLY, we didn't have those ETFs established until at the end of the 1990s, early 2000s. We did have the NASDAQ versus the S&P 500. And when I went back and looked, the NASDAQ outperformed the S&P 500 by double during the 1980s and 1990s. So if we're in a secular bull market now, and right now, the NASDAQ is up close to double the S&P 500. I don't remember exactly what, it might even be more than double since this secular bull market began. And if we're in it for the next 10 years, I believe the NASDAQ will continue to outperform by a wide margin over an extended period of time. And if that's the case, I expect our portfolios to do well. So let me go ahead and pull this back down now. And to wrap things up, I wanted to look at the strong earnings chart list. So this is where we're going to get most of our stocks in our portfolios. Now, this right now only has, I think, 230 companies on it. If I pull up the edit, our strong earnings chart list, 239 companies on here. But this is only through February 7th. I have to update the strong earnings chart list, which I'll be doing. I've started it today. I mean, there's so much going on right now leading up to these portfolios. It's just really hard to keep these like the SECL up to date. Because not only do I have a lot of work going on, a lot of webinars and so forth, but there's also a lot more of these earnings reports right now. So it's just hard to keep them up. I'm going to try and get these updated, though, for you here over the next couple of days, and then get those out to everyone. And I'll be using that updated strong earnings chart list then to select the stocks in our portfolios when we do this on Monday. All right. What I would say is, if you put the strong earnings chart list into summary form, and then one thing you can do is just sort it by scooter. And here are the top relative strength stocks on our strong earnings chart list. And you can see materials, energy, materials, energy, materials. You got a few sprinkled technology companies in here. One lone communication services company. Here's one lone discretionary company. But here's how I would start to put these portfolios together is I want to look at the ones that have been performing the best. But I also am going to want to look at some that maybe haven't performed as well. You know, we could maybe look at the last month performance and then sort it in percentage change order and then flip it to the bottom and see what has not been working. And here's a list of things. Here's some semiconductors. AMD has not been working. Marvell, KLA, 10 core. Well, not 10 core anymore. KLA Corp. These are all companies that have really struggled over the last month. Where are the energy names here? I don't see any. How about materials? I don't see any. Financials, don't see any. Instead, what do we see? Discretionary, discretionary, technology, technology, discretionary. This is what I've been talking about this whole webinar. We are now seeing the weakness, the technical weakness in these groups. And until that changes, I think we got a problem ahead for the S&P 500. So one of two things is going to happen. Either I'm right, and we are going to blow through that neckline support on the S&P 500 and head back into the 3000s, or we're going to move back up. And if we move back up and take out recent highs, I'm going to be paying very close attention to a lot of these relative ratios that I talked about tonight. So essentially that is it for me and for this webinar. Again, I hope for those of you who are new to Earnings Beats, you'll try us. We have a 30-day free trial. So you do have to give a credit card for that, but we will let you know before your 30 days is up that you are going to expire. We're not going to just hope you forget about it. That's not the way we operate. We will reach out to you, make sure you want to keep the service. And 30-day trial gets you to Monday's event, gets you a whole lot more than that, but it'll get you to that Monday event. It also gets you to the Saturday event, where I'm going to be talking about a lot of growth stocks that I think are being overlooked right now. And I'm keeping them on my radar. And when I think the bottom's in, I'm going to own a number of them, because I believe when inflation peaks, just like I showed you earlier on that chart, when inflation peaks, aggressive stocks take off. So you want to already have a list of companies that you are really interested in owning. I can tell you without even looking, Tesla is going to be one of the top stocks on my list. That when I believe the bottom is in, even if Tesla looks like it's going lower, I am going to start buying Tesla. So anyway, that's it for me. John, I don't know, we have some questions.
A couple questions, a few people commenting that keeping the door open to changing portfolio midstream is a good idea. Somebody else commenting, if you're negative short term, how come you just don't go into cash for the next 45 days? I know you've been in a lot of cash lately.
Well, personally, I have been in cash. I think the question's probably talking about portfolios. You have to understand the portfolios were designed for people who don't trade. I mean, our members, if you trade and you hear me saying, I'm bearish, get out of the stocks if you want to get out. I mean, there's nothing, I'm not controlling you and keeping you in the portfolios. I'm just saying that these portfolios are put together with long-term buy and hold type people, traders, not traders, investors, long-term buy and hold investors in mind. That's the whole idea. That's why we don't have stops, because a stop is a trading concept. It's not a buy and hold concept. I mean, if you buy and hold, you're buying and holding. The only difference with our portfolios is that you're only buying and holding for 90 days, not buying and holding for a lifetime. So we're always trying to put leading stocks and leading industry groups every 90 days. So if you want to stay in the market, but not really worry about it on a day-to-day basis, that was why these portfolios were designed in the first place. So I want to be careful about turning them into trading vehicles. And even, you know, what I said tonight about maybe swapping them out during the quarter, I don't want to get in the habit of doing that, because I think that can really, it's just not good for somebody who is trying to invest for a longer period of time to get into these stocks. And then a week later, me say, okay, we're switching them all out again. That's not going to be very appealing to somebody who's got a longer term buy and hold kind of mentality. So our service is designed for a lot of different folks. It's not just traders. And that's the question that comes up all the time. Why don't you have stops? Why don't you why don't you go to cash? It's because these were not designed as, we have so many research products and services that are designed for a trader. The portfolios really are not trading vehicles. Although I'll be honest with you, almost every one of the stocks that I put in there, I look to trade. I think they're among the 40 best, 10 stocks and 4 portfolios. They're among 40 of my favorite stocks. Otherwise, they wouldn't be in the portfolio to begin with. So I like to trade them. And I know we've gotten a lot of feedback from members who also like to trade them. You just have to decide what your strategy is. Are you long-term or are you short-term? If you're a trader, then, and you want to be in these portfolios, that's fine, but stops might work for you. We try to be very transparent. I don't want to get into this thing where we switch out stocks continually during the day, because we'll pick a stock and get into it. Let's say we want to get into Tesla at $930 and we get in intraday 930. And then we've got a member who, for whatever reason, maybe doesn't even see the email for 2 or 3 days, and then looks, and now the stock's at 970, and they're like, well, what am I supposed to do now? So we've tried to set these portfolios up so that they are very transparent and they're very easy. So it's not, oh my gosh, pay attention to your email, here comes another trade in the portfolio. That's not what we're trying to do. So spend a little time explaining that, but I think it's important because that's a question that always comes up about our portfolios. I think they're an educational tool, and I think they're more designed for those who are interested in buying and holding those.
Okay. Even though we're not into individual stocks tonight, somebody attended the Max Payne last night. Mm-hmm. Love for Tom to talk about Facebook, pins, and PayPal.
I took losses on all 3 of them, and then they came back a little bit. So, yeah, I was a nervous Nelly. I'm really nervous about the market overall. And when we started to roll back over this morning, I think Facebook, was it Facebook? No, it wasn't Facebook. I think it might've been PayPal that I got stopped out on. And then I was just looking at the account. I'm like, all right, I'm moving to cash. Basically, any of the gains I had yesterday, I lost today plus some. And so I got out. I still think there's plenty of room to the upside, though. I think the market could go higher. And I was even looking at the 2 o'clock minutes that came out from the Fed. And I thought, okay, this could be doomsday or it could be a relief rally. And with the VIX where it is and wide areas of, wide trading ranges in play, it's like, I don't know where this thing is going to go. So I just decided I wanted to be in cash instead. So the only thing I've got at this point is gold. I really like gold. I continue to like it. I think if the market weakens and we've still got a lot of nervousness in the market as we go forward, I think gold is going to do very well. As far as these charts that you just asked about, I mean, Facebook's gotten crushed. Do I like this chart? Do I think this is a technically bullish chart? Absolutely not. Do I think that because of Max Payne, we could see a rally for the next couple of days or maybe even the early next week? Yeah, I do. I think we could. I wouldn't be surprised to see Facebook at 230 or 240. Now, do I think it's going to 230 or 240? I don't know. I mean, if it had worked out for me today and if it had made it to 220 or 225, I probably would have been out. I just get my money and move back to the sidelines. I don't try to scalp every penny that I can get off of a trade, especially in this market. If I can make money, I'm really happy. So I wasn't very happy today. But that's Facebook. Another one, PayPal. I mean, I was looking at this chart today. My gosh, when is enough pain? When is pain enough pain for PayPal? They should change their name to PainPal, because that's all that they've been in now for about the last 6 or 8 months. Look at this move to the downside. I mean, they've got every reason to go higher. The market tried to rally this afternoon, went positive, and PayPal, even with the rally, I was joking to John earlier this afternoon and said, if the Fed came out and cut rates and said they were going to start buying bonds again, I think PayPal still would go down. I don't think there's anything that could be done right now to help PayPal. And I'm saying that half, sarcastically and half truth. I mean, I don't know what's going on, but Wall Street does not like what is happening at PayPal. So do I think it could come back? Yeah, but this is the one that I got stopped out. I had to stop in under the prior day's low. This one I had set because I thought the chart was so ugly. I didn't want to hold it if it broke down. And it's really from learning a lesson on plug power from, I don't know which, it was probably back in this time frame or something when Plug Power was getting absolutely crushed. And I stuck with it and even bought more as it kept going down. And I took one of my biggest losses of the year trying to average into a stock that just never wanted to go back to the upside. I learned my lesson. And so now when I get into a stock, if I get into a stock like PayPal, I set a stop, at least a mental stop, because I'm kind of watching the market. And if it violates that number, I just get out. I don't ask questions. If I get whipsawed, I get whipsawed, but I don't want a big loss. So that was PayPal. And then the other one was Pinterest.
Yep.
Yeah, this one looks like it's still trying to bottom. I mean, we've got the double bottom in, rallied off an opening, drop. 20-day test, if we were able to get that, which is up at 27.63, that's a couple dollars higher. I mean, if we were able to get that, I'd be out. I mean, could Pinterest go to 30 or even up to test the 50-day? It could. But I would make sure I keep my stop in play on a breakdown. And then also, if I got to the 20-day, I'd be ecstatic. I would take the money and just run.
All right. Somebody curious what percentage of your capital do you have in gold? It's up to you if you want to disclose.
I have one of my retirement accounts in gold. 100%.
Wow.
I mean, I don't expect gold is going to go down. I mean, let's pull up the chart on gold. And I'm very aggressive. And I mean, when you look at gold, gold doesn't really move a lot. I mean, just look at the last year. And if we look at, let me pull up a rate of change here. And just do like a rate of change over a month. So let's just say 20 days, which is 22 days is roughly the number of trading days in a month. I mean, if we add that down here, I mean, if you go back the last several months, I mean, 5% is a big move in gold, one direction or the other. I happen to like gold a lot. I think the pattern, if we go back and stretch this out to a weekly chart, I mean, we hit this high, and then I think what we've got are rising lows and falling highs. And we actually made the breakout here. And I think this is going to eventually go up and test this high from August of 2020. I think we're going to go back to $2,000 gold, which from here, even now, would probably be still roughly a, what's that, $130. So maybe about 7% from here over the course of, I don't know, maybe the next few months. I wouldn't be surprised by March or April for us to be at 2,000 on gold. This closed, by the way, today of 1871 was our first close above 1870. This move back here never went above 1870. So now it looks like we have a open door, maybe up to about 1900, 1910. And then if we get through that level, I'm looking for 2,000.
Okay. Should wrap it up.
Okay, that was it.
If we miss any questions, people can just write to support@earningsbeats.com, and we'll try to get back to you.
All right, sounds good. We do have two big events though coming up. So if you are in here for the free event and you want to check those two events coming up, Saturday and Monday, 30-day free trial gets you in. Free trial, 30 days. So anyway, you can check us out there. And again, like John said, if you have any questions, you can send them to us at support@earningsbeats.com. So thanks for tuning in, everybody. And I'll try and get that strong earnings chart list, some of those other chart lists updated here over the next couple of days so that you can have those. And then, of course, the growth stock opportunities event will be on Saturday at 10 o'clock Eastern. So everybody have a great day. And tomorrow, hopefully see you over at stockcharts.com on Stock Charts TV for my next Trading Places Live show. Take care, everybody. Happy trading.